loss of 9 cents, reporting 6 cents loss. Yesterday, loss of 9 cents. So that's a beat on earnings and on revenue. Iran's UN envoy said, "We are not going to close the Strait of Hormuz, but it is our right to preserve peace and security in the waterway."
That sounds positive. One, two, three.
Crude is dipping on that headline.
Four.
And the Iran's UN envoy said, "We're not going to close the Strait of Hormuz, but it is our right to preserve peace and security in the waterway." LOCO, Pollo Loco, reporting adjusted earnings of 25 cents. The estimate was 20 cents. That's a beat. Sales of 123 million. The estimate 122 million. So that's a beat for LOCO, Lima Oscar Charlie Oscar.
One, two, three, four, five. What's up, Mario? Mario! How's everybody doing? I'm just getting a few charts together we can look at. Okay, I guess I could get some of the others. All right. Screen is good. Let's get some of this crap off the screen so we can see straight. And let me mute some stuff. And we'll get rolling here. Okay. You got some earnings. Oh, wait, sign into chat. Do I have to sign into chat, Mario? I don't have to sign in, right? I don't know if I see Mario's comments. I don't know if I need to see everybody's comments. But Mario says audio working, everything working good here. Okay. All right, so let's get into things here. Thank you, Mario. All right. I mean, obviously, I don't want to spend too much time today talking about what kind of everybody is talking about. I'm sure you're kind of sick of a lot of the war rhetoric and everything else, and people's opinion on the matter and that sort of thing. But unfortunately, we have to pay attention to some of the macro stuff that's being affected by, again, this war or the threat of some consequences of this war. They're moving some things around in the marketplace, right? Dollar yields and stuff like that ultimately will have an effect on equities, and that's what we're seeing out there. Just to quickly rehash kind of where we left off last Tuesday. While basically just a quick summary, while we're seeing things improve, and when I say improve, sentiment positioning becoming a lot cleaner, the market really starting to wear out bulls, right? It's been a slower process because we haven't really had that rinse, that full cleansing that we would like to see. It's been a more methodical, gradual process. A lot of chop involved, a lot of snapback rallies involved. So we kind of left off last Thursday that there's nothing out there screaming for us to kind of jump in the middle of this, right? Even though things look a lot better than where they were a month ago, right? Because there were definitely some things out there that were concerning a month ago. Because of the noise, the backdrop of the war, and some parts of credit, which we'll talk about, there's a lot of good coming out of this. Now, when will this all resolve becomes the question, and that's kind of what I want to spend a little bit of time about today. Just looking at what are the questions we should be asking ourselves right now, right? Because I think the answer to these questions may differ from player to player, depending on your appetite for risk, how aggressive you want to be, how patient you may want to be, right? Some may want to be more conservative in approaching this. But I think there are certain questions and certain things we should be asking ourselves, paying attention to while we wait on a resolution here, okay? And again, when I say a resolution, I'm not talking about a resolution to Middle East chaos, because honestly, there'll probably never be a resolution, right? There's always something that comes about. And even if this war kind of goes away, which it very well may go away for a little bit, certainly can pop up in a couple of months, right? So I'm not talking about resolution in real life terms. I'm talking about resolution to kind of what's weighing on equities, what's getting in the way of upside in equities. I think that's the issue here, right? At the index level, and you guys know my take on this. I'm not going to try. I don't want to stress the resiliency of the indexes, okay? Because I think that's been very misleading, and a lot of, especially retail traders, have been hammered because of that being misled. While the indexes have hung in there rather well, underneath the hood, you got a mixture of bear markets, corrections, and outright crashes in a lot of things. Okay. So while the major averages have been hanging in there and have yet to really participate in this correction, because this is a correction, there are things that this correction has already run its course. Now, there are still things that are putting pressure on these pockets. We'll talk about that, and that's what I'm getting at here, right? Ultimately, there's going to be a resolution to where either there's too many bears and no more bulls left in these areas, right? And the opportunity is that the majority of the selling may be close to over, even though the upside's not there yet. Or, certain signals we pay attention to flip bullish and give us a bit of an all clear to try to take advantage of upside momentum. Right. And these are the things I kind of want to talk about today. Right. So let's quickly talk about that. Right. And here are, where am I? So I don't get lost. Here are a few of the things we've been looking at, right? Some of the major things we've been looking at, especially last week. Okay. Okay. VVIX, right? We talked a lot about just the vol complex, right? VIX, VVIX, MOVE, all these different vehicles of volatility. We spent some time on it. I'm no VIX aficionado, right? I'm no volatility aficionado. You have your share of them. You can go on social media. There are a ton of them on there who claim to know the VIX and the mechanics and gamma and all that inside out. That's not why I look at these things, as many of you know. A lot of times the divergence, right? When you see divergences, they can be early clues to kind of a risk on, risk off backdrop taking place, right? So one of the things we've been talking about for a while is like when you're getting a clear risk on signal from a lot of the market, right? what we like to see is kind of these vol instruments, the vol complexes we refer to it, confirming that, right? So if stocks are showing strength, volatility in all likelihood should be weak, right? If not aggressively selling. That's not always the case, right? There are times you get vol up, spot up, as they say, but the best of in bad environments, right? The cleanest of backdrops, when you can have some conviction and feel comfortably long, is when vol is selling and while equities are rallying, right? So what we've been looking at is this is an inverted chart of VVIX, so flipped, so you can see the correlation with the S&P 500. And again, we just want to pay attention to overall trends here. All right, we kind of dissect this a little bit more on an intraday basis in the steam room, but on this webinar, without getting too much into the weeds, we just want to look at overall trend. All right, and you can see here, green arrow, higher lows, equities making higher lows, healthy environment, pretty decent tailwind out there. And then when the calendar flipped into early 2026, that started to change, right? Now we started to get that lower high, lower lows situation, right? So a bearish trend, as you can see with the arrows. And even, puts things into perspective in a sense. You get these market snapback rallies, you get sell-offs, and big picture wise, nothing really has changed. Nothing really has changed. A lot of the times we see the equity market rally, and at some point when that rally kind of runs its course, sometimes just one day, maybe a couple days, we start to get bearish divergence in a lot of these things we look at. Some early clues telling us that it's just a short covering rally and it's close to running its course, right? These sort of things. So where we're at now, basically, is kind of equities have caught down to the divergence we've been seeing in VVIX, right? They kind of are in sync. So again, let's see, maybe we start to see some bullish divergence here where the equity market weakens and VVIX weakens alongside with it. Okay. These aren't signals on their face because you can run into bear markets where vol comes in and equities still aren't in great shape. We like to use all these things together because when they all align, right, and are telling the same story, you get a stronger signal. Okay. So right now we're kind of caught up here. There's no real significant divergence, in my opinion, to talk about. As you can see on this chart, things are pretty much in sync. All right. We did have some bearish divergence, if you remember. Here's VVIX normal look. And again, you can see, right, higher lows as the market started to roll over, or even more importantly, as the market was hanging out near highs. Okay, so you still got a pretty decent bid in VVIX as high as it is. We're likely, you usually don't hang around up here, right? What I'm getting at is usually either shit hits the fan and you get this kind of explosion, almost like a blow off top type thing, but the markets kind of flash crash, or you get this slowly start to unwind. Okay. Because again, a lot of volatility is being priced in. So we should see a resolution of some sort sooner than later here. This has been, as you guys know, kind of the main culprit to put in the worry column, right? I guess the best way to put it. While equities, have looked okay from time to time, right? You get these snapback rallies, the indexes, again, using that word, showing some resilience. They can't roll over. But the problem has been credit, the things we look at in credit. Okay, now I'll explain that in a second. But a lot of the credit signals we like to look at have not been showing anything close to all clear, right? Or that the concerns have gone away. Okay, I don't want to give the wrong impression that credit has been setting off alarm bells, because you're hearing 2008 comparisons out there again, which is totally normal, right? But we're not seeing that, okay? But what we are seeing is anytime the equity market catches a bid, right, and snaps back, our credit signals, as we like to say, basically just spit on that rally, telling us that it's short covering, and there's no legit health behind the snapback move, right? And as you can see here, what's been a problem again, because keep in mind, you're looking at where are my charts here? Hold on, bear with me. You're looking at an S&P 500, right? And a line chart, it looks nice and easy, but you get these moves, right? Like this, up and down, right? It doesn't go straight in the direction up or down. You get a lot of these up and down moves, and I think that's where a lot of these signals for me add some clarity to the picture. Okay, so while you're getting that up and down move in the market, this is kind of what our credit indicator has looked like. Right? I mean, simply put, just rolling over here, right? Even as the equity markets, I'll give you an example. Was it yesterday or the day before? We bounced, right? We had a decent bounce in the market. I think Oracle had good numbers, whatever the case. But credit indicator here, as you can see, making new lows. Okay, so obviously something's not right. Okay, in a risk-on backdrop, what we want to see is, again, that correlation, right? Or at the least, not rolling over, right? So we're seeing the complete opposite, and that's, again, bearish divergence that we don't want to see, and it's telling us that we shouldn't trust rallies. So as of today's close, the last 2 days here in credit have looked lousy, as you can see on this chart. This is where we were at the end of the day today. And again, this is just not a promising sign up to this point. Now, things can change tomorrow or early next week. Okay, it's not really a predictor of things. It kind of gives us a health check on how things are right now. Okay, the signal, or the signal is what I'm getting at. That's why I have a problem here. Hold on. The signal is when we're getting a different one read from our credit signals and another read from equities, right? That's the opportunity, I should say. Let me make this like this. Hold on. All right. So what I want to see, one way or the other, whether the market's still selling or not, is kind of irrelevant in a sense, because even if the equities start to sell, if we start to see some bullish divergence out of these signals, in credit in particular, that's a really constructive sign, right? And that will be guiding us, or at least us in the steam room, to looking to buy that weakness, because, again, our credit market signals are telling us a completely different story than what equities may be telling us. All right, so that's what we kind of want to see on a bigger picture view. And give you some examples. Like here was really a strong signal. You had the equity market weak in 2023, towards the end of the year in 2023 into November. And if I remember correctly, I think it was just comments. I think it was just rhetoric from the Fed or Powell, something to that effect. And you had this ridiculous rip, right? And, again, equities were starting to push higher, coming off some selling, but nothing as drastic as this, right? So this was kind of confirming to us that we are in a risk-on environment, or at least the credit market, the credit signals we're paying attention to is telling us we're in a risk-on environment, and we kind of got a green light for risk assets, right? And again, we're seeing the opposite of that now. We're seeing the complete opposite of that, okay? Now, I just want to talk about credit because you guys hear a lot, CNBC. If you look at quality credit. Okay, so if you look at AAA and triple B rated credit bond yield spreads, they really haven't been moving that much. Okay, again, they're a lot of times I wouldn't say the last to move, but out of the credit stuff that we pay attention to, there are times those don't move until really shit starts to really hit the fan. Not always, but it's certainly possible. Okay, there's a reason why I like to look at certain credit readings more than others, right? But just because you may hear some misleading things out there, not that they're misleading, but top quality credit out there is still doing okay, right? But what we pay attention to in relation to equities, because we're not buying bonds, we're using these things as equity signals. Our credit signals have been telling us a different story here. Okay, that credit is a concern, at least a big enough concern for equities at the current time. Now you're starting to see that impact in financials, right? You certainly have seen it in these PE firms. Owl, that stock goes down every single day. XLF starting to look fugly over here. Okay. So, and we'll spend a little bit of time talking about this, but depending on what type of player you are in this game, especially certainly if you're a trader, a tactical trader, it's really difficult to find any conviction in buying financials when our credit signals are telling us we shouldn't be. Understand? No matter how much they may have come in, or no matter how good they may have looked a month ago, because they certainly don't look as good now. And when credit's telling us a different story there, it's just hard to have any conviction in buying. Right? Now, if you're talking about investments and you're looking to buy, Citi and buying pieces, maybe that certainly could make sense. But for the style, for the way a lot of us trade, it's a completely different story. Okay? So again, not to beat the drum here, but it's an important thing for me. I kind of lost where I'm at here. As far as getting a gauge, clear risk on, risk off. Okay. Let's talk about this here. I don't want to get too into the weeds macro, but I think it's important. Here's the problem as we get into this. Okay. You have the Iran war. Okay. For whatever reasons. What's been going on here recently, you have the dollar has been strengthening, yields have been rallying, right? Interest rates have been rallying. Crude obviously has ripped, okay? All these things, if you remember our conversation over the last few months, this is the makeup of financial conditions, right? We talked about how easy financial conditions are, right? We talked about what's the main risk, kind of, in my opinion, was the only risk to take down cyclicals. Remember we had that conversation? Like, you can't chase cyclicals after the run they've had because there's a risk. If financial conditions start to tighten, you got some room for these things to come in because they rallied so much, right? Now, again, I'm not Nostradamus. I didn't know when or if financial conditions were going to tighten, but that was the risk. So we're seeing that play out right now. And the war is the main culprit, the main catalyst. Okay, you look at a chart of the dollar, yields, crude, all up over the last couple of weeks. And now you got financial conditions, if you remember when we were looking at it, down laying here in the green, right? Extremely loose. And that's the perfect backdrop to buy cyclicals. Now you've got a completely different story. Okay. And from my experience, one thing I've learned, when you got financial conditions tightening and you got credit spreads or credit swaps widening out, you got no shot of equities finding any upside follow through. Right? Because as that goes on, as I like to see, you got algos on insta sell. Right? Things may rally, but they're likely going to run into selling because financial conditions are tightening, credit spreads are widening. These quants are just looking for things to sell that may be up. And that's what we're seeing. And that's exactly what we're seeing. Okay. So what I'm getting at is, this is not going to last forever. Okay. But while this is going on, you can't expect to find much of any follow through to the upside. Okay. So we need this fever to break. And what you got going on, I think, is kind of two sides of the coin here, where the market has given players a decent amount of time now, right? If you look at it, right? Let's just take an ES chart here in particular. We've done a whole lot of nothing, right? And while this has done a whole lot of nothing, underneath the hood, as we talked about, you have had pockets of this market get hit over the head. Okay. If you look at like single names, there's stuff out there that is maxed hedged right now because of the pain that's been going on. Like software, you've had an all-out crash. Okay. So what I'm getting at is you had ample time for players and funds to remain hedged, protecting downside, right? So protecting kind of a crack where the market would roll over, right? You've had this uptrend in VIX and VVIX, as we spoke about, right? That's been lingering now for a while. So you got a market that's kind of well hedged, and at the same time, on the flip side of the coin, so that's kind of preventing things from falling apart. But what's capping the upside, you got financial conditions tightening, you got credit deteriorating, right? And that's capping the upside of the market. And that's why you get a whole lot of this. So we need this fever to break, right? How does it break? There's a number of ways it can break. We were talking about this in the Steam Room recently. The market's known for some sort of crack, an event, something happens that gets this fever to break. Think SIVB, right? With the regional banks. Think the UK gilt market in the fall of 2022, right? So something eventually gets what we're seeing here to change, where you start to see rates start to drop, right? Yields start to come in. You get a growth scare, right? You get something to worry about that ultimately gets the Fed back involved and kind of rearranges everything into a more bullish look. Right now, you got interest rates going higher. You're worried about some sluggish economic growth, even though it may not be a catastrophe. Who wants to get long equities into that? All right, there's no incentive. There's no incentive, no motivation to get aggressively long into equities. That's why you're seeing like pockets of chasing in some of the only stuff that's seeing growth out there, like some of these optical semiconductor plays, right? Now because of the way you're seeing ag names and energy names, right? These are the little pockets of growth while you have financial conditions tightening the way they are. Okay, so again, we need this to break. It will break. All right, but until it does, we're kind of I'm lost again here. Oh, we're kind of caught in the middle here. We're caught in the middle. Now, as you can see, market does just because financial conditions are tightening and credit spreads, credit swaps, and the spreads we look at are widening out, doesn't mean the market is going to roll over and crash immediately, right? Because you get days of relief. Trump comes out tomorrow, talks softly about the war, crude goes down, dollar goes down, yields go down, financial conditions ease, right? So you get these little bouts of relief. Ultimately, what is behind some of these snapback equity rallies. Okay, so that's kind of, I think, what for us in the trader department, I think that's what we want to keep an eye out for. All right, that's what we want to look to take advantage of until we get a resolution. All right, we don't want to look for the resolution. We want the signals to come to us and scream there's a resolution. But until we get it, I think that's kind of, tactically how we want to approach things to get through this period of time. Right? Because one or two things, as we talked about, one or two things are ultimately going to happen. One is we either get a break of this fever, right? The bad recipe going on here. And you go through a period of relief in the market and equities. Okay. But for me, like big picture, I don't even know if that really changes anything big picture. Now, I could be wrong, but I think let's say like this war, we come to a resolution in this war, right? Trump tacos, he's had enough. Crude, he can't take it anymore. He wants to meet with the Iranians, and they start moving carriers out of the Middle East, and you get some resolution. No doubt you're going to get an equity market rally. Okay, no doubt. And crude is going to come in and all that stuff. But beyond that, I think we're still back to where we were right before this whole Iran shit came to a head. And if you remember, it was a lull in a sense. So we need the juice. I hate to sound like a crackhead, but we need the juice. We need a growth scare. We need the Fed to get back in our corner, and we're going to need Trump to kind of juice things up stimulus-wise, however he can, to really get some exciting growth out there for that appetite to show up again, right, from this point. So, what I'm getting at is it can go so many different ways, and we don't want to search for these things. We want to kind of let it come to us and let the signals talk to us and then react in a sense. That's ultimately what I'm getting at. All right. One more thing I had on here, which is interesting. Here's kind of internals, and you can see what we've been seeing recently. After you had, if you remember, we talked about this, new highs and new lows both expanding, all right, which is not a healthy thing. So the new high list and new lows were both expanding. Okay, I was telling you about the bifurcation in the market. Now you have where new highs and new lows are both receding. Less new highs, less new lows. Goes to show you about stuff oversold, extremely oversold, and other stuff overboard. You're kind of in that chop zone. What you want to see at a bottom where you get that kind of that puke panic bottom, you get this, where everything goes down together, right? That final wave of selling, and you get a spike in new lows. So we haven't seen that yet, as you can see. Okay. And one of the reasons is because, some of the stuff there's some stuff out there that's been selling for a long time now. So eventually they stop making new lows because they've already crashed. Okay. Like software. We've seen some of these things, rally back. But a lot of times at the end, like if this runs its normal correction cycle and we're going to end in correction, you get everything sell. Even it may be a shorter period of time, but you get everything that sells together, and that kind of puts in the bottom, right? So I found this interesting that you had both these things coming down together. A few other things, because again, what we see on a positioning sentiment view now, let's talk about that, right? On the sentiment positioning side of things, if you remember, we talked about this last week, just not there yet. Right? You don't have enough of a washout to take a stance and say that the bulk of the selling is done. Right? You can make the case that players are well hedged right now. They have enough hedges on. You can certainly make that case. you can make the case that we are oversold in certain pockets on a shorter term basis. Okay. But our quote unquote big picture indicators, as we like to call them, they're just not there yet. You haven't had enough selling in fear that we usually see at major lows at the end of a correction. Okay. And, that's the reason I bring that up, is that's what you want to see ultimately. If you're going to stick out your neck before some of these more constructive clues start to appear, you want to at least see that, right? Because if you start dipping your beak before you see that, and there is a decent amount more selling still left to be had, obviously it can be quite painful. Okay. So on a sentiment positioning overall kind of view here, like I said, a short-term basis, you got kind of a little oversold breadth in certain pockets more than others, and players are well hedged, especially into the March OPEX. But big picture wise, yeah, you're just not there. You're just not there. Here is hedge fund exposure. And you can see they're just really not doing anything here, right? They tried to buy this dip a few weeks, I think it was a couple of weeks ago. They got run over. They spit that up, got back to neutral. Here you could see earlier this week, they try to put on a little exposure. I wouldn't be surprised if they spit that up today. So they're not really showing any conviction at all here. They've been hugging the zero mark, which they've done for a while. And again, they're hedge funds, so they should be doing that. But at extremes, as you guys know, that's why it's a pretty decent signal. Okay. This is our short-term, one of our short-term indicators we like to look at. And this is kind of what I'm getting at on a short-term time horizon, that you got some stuff there already. So here's what I would say. If you're looking to play the snapback rally, right? That snapback trade, and that snapback trade basically just when short-term sentiment gets washed out enough, you put on, long calls or whatever it may be, looking for that snapback sentiment rally, right? You're there. In my opinion, you're there. After today's weakness, you're there. Okay. Again, corrections, these are short-term indicators. So corrections, you could be early off these indicators, right? That's why they're short-term indicators. But not only that, it's not even that you're early. A lot of times they can linger. If you look back in corrections, this wasn't even really a correction in November, but it can hang out down here, right? As things still need to materialize. All right. Because again, big picture wise, if you look at overall major positioning on an intermediate / longer term time frame, it looks nothing like this. Nothing like this. We just got back to neutral basically, or a little. Neutral. I'll show you here. Look. I should see it here. I'm thinking. Hold on. It's got to be in here somewhere. Where's the Deutsche Bank? Here it is one, right? Here's the Goldman one, neutral. And then you got Deutsche Bank we like to look at. This one. This is a nice big picture indicator. All right, neutral. Okay, again, here, last year's correction, April Liberation Day lows. That was the bottom. And we're here now. Okay, again, it can happen quick. If the market rolls over, let's say we get through March OPEX, hedges come off, and you get some selling for a week and the market's cracked, you're going to get there quick. So this is not that far away. The selling has already been underway in a lot of these things. Okay, we're just not there yet. We're just not there yet. Here's kind of positioning so you can see. Discretionary, little below neutral. These are the systematic funds, which are sellers now, right? We talked about that, the CTA funds and stuff like that. They're in the process of taking down that long exposure, right? That kind of intermediate threshold has cracked, and those fund flows have now tilted bearish. Okay. By the way, that's another headwind in the market, right? These systematic funds are now net sellers in every tape. Okay. So again, just so you get the time frames, right? Because time frames are important, especially in this type of climate. Time frames are important. Let me go. I don't even know. Was that? Okay. Hold on. I got a few other cool things to look at here. Here are credit default swaps. And again, this might be a little misleading because I blew it up so you can see the move. This is not that big of a move, but it's a move. Okay. Again, when credit default swaps are doing this, you're not going to see equities do that. Right? You're going to get the inverse. And many of you who are on this webinar know how long we've been looking at this stuff, right? As long as you know me. Throughout the 2022 bear market, right? There really wasn't a reason outside of trading squeezes to get long for most of the year. Well, this is blocked out, but if you would look at a chart of credit default swaps, right, they were in aggressive widening mode. So this is the move recent here from January. And again, it's just going to cap upside and likely weigh on equities. Okay. Here's some of that breadth I was referring. So you remember when we were looking at this chart and you had a lot of red on here, especially cyclicals. We were talking about how that could be a problem. Now you got a lot cleaner look here, right? If you remember that look compared to now, a lot cleaner. Okay. But again, it's mostly on short-term time frames. Okay, this should look even better today after today's action. So that's why I'm saying if you're looking for that snapback sentiment squeeze, I think you got enough for that right now. You got enough for that. Sentiment trader, this is a nice one I like to look at in corrections. Smart money confidence is the name of the indicator. And usually you get up above that green line. We're getting closer. Here's the April liberation tariff correction. We got actually above that green line, the first low, and then you rolled over again from there and then got even higher. But you're usually in this neck of the woods. And these are some of the things you see at the end when you're closer to the end of corrections. You see a lot of these things start to line up, which they're not quite there. Here's another one I like to look at that some of you may remember from last year. It's over here somewhere. Hold on. Nope. Is this it? Nope. Hold on. Bear with me. Well, I'll talk about that in a second too. Oh, is this it? Yeah. So this is like kind of the panic breath. Think of a puke indicator in a sense. You get up over 40. And usually when you get up over 40, it has a tendency to go even higher than that because there's real pukage. It's a good sign that people are just giving up. All right. And the reason why that's important, guys, is because if we're not getting any bullish clues from the other stuff, right? If credit is not showing any constructive signs yet, if sweepers aren't showing much of any constructive signs yet, right? If any of that other stuff is not really too convincing, You want to see this stuff start to light up green, because at the least you can make the argument that the bulk of the selling may be done. Maybe even if the upside is not there yet in the equity market, at least there's a high probability of a decent floor being put in because everybody has already sold. You understand? And I'll give you a good example of that. 2022. Okay, the bear market in 2022. Most of you remember. You're not that young. Oh, hold on. In 2022, the summer of 2022, you had a lot of these things we're looking at, which signal the bulk of the selling has already played out, taken course. You had a lot of that stuff show up into this low. Okay. Now, again, if you think about back in 2022, you had credit default swaps and spreads still widening out. The Fed was purposely tightening financial conditions. You see what we're doing, what we're seeing now, the problem? The Fed was purposely creating that problem to battle inflation. Okay, so that's what you were battling on the signal side. But at this point here, because it was obvious to everybody at that point, everybody got out, right? You started to see some of these big picture signals indicate that the bulk of the selling, the majority of selling has already taken hold. Okay. Now, again, the market has squeezed again. We ultimately actually made a new low, but this is a perfect example of the bulk of the selling already done. All right. Because everybody already sold into this low barely even breached before buyers showed up, and eventually we bottomed and made a low. You understand? So net, there wasn't any huge, it wasn't the start of a bull market, I guess is what I'm getting at in the summer. But because those washout signals were all signaling that the selling is already done, you had a floor in a sense in. All right. So that's, the main thing, to be honest, why I like to look at all of these indicators, because even if I'm not seeing constructive signs from the stuff I look at every single day, the more actionable signals, the clues, if you're looking to, again, a perfect example like we were talking about earlier, I'm just rattling off names here. So let's say JP Morgan, you think it's all oversold, you want to buy it longer term, there's not any sweeper activity yet, the credit signal's still not looking that great, VIX didn't roll over yet, right? All that stuff, nothing signaling yet, but all these washout signals are flashing bullish, telling you that the bulk of selling is done. You have some incentive if you want to start buying pieces of JP Morgan if you like it, because you think, because you not because you think, because you want to own it longer term. Right? Because even if it goes a little bit lower, those signals are telling you that the majority of players who needed to sell or wanted to sell have already sold. So again, I'm just the logic behind it, right? Is what I'm trying to share. Okay. So again, we're not quite there yet. Here's another cool one: PE VIX spread. All right. A lot of times you see this come in. Here was the Liberation Day lows. These things are only useful in corrections. Otherwise, you're not going to get a signal anywhere. Okay. Here's when we talk about well hedged. Here's what we're referring to. I'm sure you're hearing that a lot on CNBC. You see it on social media. This market, they have enough hedges on. People are well hedged. This is what we're seeing that signals that. This is the Vol Panic Index from Goldman. You're at 9.7, roundabout there. The max is a 10. That's pretty much players are max hedged according to this indicator. And yeah, that's again, if you're looking for something constructive, this is probably one of the more constructive things. All right. Why? Because here, let's say even a catalyst, there are plenty of potential catalysts out there, but we see it all the time. Futures sell overnight. Ding, 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 market opens. What happens? They buy it right up, right? Are they buying? Not really. What's happening is players have hedges on and they're unwinding those hedges into the weakness, right? So the unwinding of those hedges is creating bullish momentum, ultimately keeping a bid in the market. Right? So that's what you got going on here on this end. I'll give you one more bullish thing to make you feel a little bit better about things on a more intermediate term perspective. Because again, I think this could end up being a blessing. Okay? Without this was going to happen no matter what is the obvious thing to say, right? We were going to run into some sort of correction, whether it was going to be now, whether it was going to be a month from now, right? The longer we prolong it, the bigger the problem it would become. So ultimately, I think this is a blessing as long as we don't end up in nuclear world war, in my opinion. As the kiddos say, IMHO. Right? But I'll give you one more good one, positive to keep your chin up. Wait, what's that? Oh, here. Oh, nope. Sharpies. I could just search it. I don't even know. Is that it? Yeah, that's it. Sharpies, right? Let me make sure. 3/5. What's today's date? Yeah, that's got to be it, right? Because we get a Sharpie update tomorrow. This is Sharpies, as we like to call them, commercial hedgers in the futures market. What they've done is they've taken off their hedges. Which is really remarkable. They had a pretty aggressive NASDAQ hedge on for quite a bit now. They've unwound that completely. Okay? So the quote unquote smart money in the futures contracts have taken off their hedge in NASDAQ completely. I mean, if you think about that, the reason why I say it like that, and I think it's a big deal, think of how bubblicious that NASDAQ was with Mag 7 AI names. Nobody ever thought there'd be a downtick in AI. They're chasing names. It got a little, well, listen, you had people trying to compare it to 99. That's how crazy it felt. The thought that Sharpies have removed that hedge completely now already, it's over with, it's quite impressive. You know, it's quite impressive. Just it makes me feel good about the NASDAQ again, where it was kind of scaring the living poop out of me for a while. All right, but this is Sharpies dealers in equity index futures as a whole. Okay, so what we were concerned about is as this market, quote unquote, was showing resilience, that dealers were gonna probably slap on additional hedging, kind of like this, right? So what would happen is as the market hung in there, they would be maxed hedged, and that wouldn't be a good sign. Okay, because they're usually max hedge when the markets roll over. What they've done here now is they've taken off their hedges the last few weeks and have flipped to net long. Now, not in a major way yet, but have flipped net long. And that's notable. Okay, it may not be an actionable signal. Some may take it as it, but it's definitely notable. Yeah. Well, that's what it is, Madden. You know how they do it. Anything that may resemble something bad that's happened, the perma bears cook it up and make it into 2.0, you know, into 2.0. You know, they quickly forget how in 08, you know what, you have a similarity for 3 days. Like in what caused 08 is the Fed let Lehman go under. Okay, that would be equivalent to right now the Fed letting Bank of America go under. Hearing Bank of America's got problems, they need a bailout, otherwise they're dead. And the Fed saying, you know what, Bank of America, what are you going to do? That's the consequences for taking too much risk. That's what happened to Lehman. It was the guinea pig. Let's see if we let Lehman fold, what happens. Well, what happened was you almost took down the whole effing global economy. Exactly. Now we have a Fed put. Now, again, you could make the argument that one of these days the Fed put's not going to work. That may be the case. I mean, we may be at total apocalyptic nuclear world war at some point too. But until we get to that point, you know, we deal with the information in front of us here. But now any little crack. Here's the good news, guys. Okay, here's the good news. Since 2008, anytime financial conditions start to tighten up on their own, okay, and they get too tight, usually something starts to show cracks and the Fed's got to react. Okay? That's the whole script. When financial conditions get up into this neck of the woods, right? Something, you get to pivot. Something's got to happen. All right? So here you had Trump, the Trump taco. Okay? Besant probably took Trump by the hair and said, listen, this has got to end now. Okay? You're at the point where you're going to create damage. This has got to end now. So usually when it's almost like us as traders, you have alerts on your screen for breakouts, right? They have breakout alerts. When these things hit certain levels, alarm bells go off and action starts to be taken. Okay? Financial conditions, you're getting there. Again, Goldman's financial conditions index is not moving as much as some of the others. I think because they have a bigger equity weighting in them as far as indexes, and equity indexes have been held up obviously a lot better. But if you look at like Bloomberg Financial Conditions Index, I think that's what this is. They all have tightened pretty noticeably here. Where the hell am I here? So usually, here it is. Usually when you get up into this area, here's 2022, okay? Here, again, we were talking about it today. In the summer of 2022, the fall of 2022, oh no, it might have been the summer, either or, right here, this, you see this? The UK gilt market, right? The UK bond market cracked. And the Fed had to take the foot off the brake. Right? You guys remember that? Here, this was 2023. I still I still don't know exactly what went on here, but it was the old QE, not QE shit. You guys remember that? This here? It's QE, but it's not QE. Some sort of liquidity, something happened right here. See? Financial conditions tightened, and then you see how they stopped on a dime, and look at that. Whoop. Right? And look, this is what our credit indicator did. Look, whoop. Now, if just on headline news, if you don't know what you're looking at, and like I'm probably in that camp as far as Fed mumbo jumbo and shit like that, didn't look like the Fed did anything. But according to the Fed guys, right, the liquidity guys, it was the old QE, not QE that caused this. Okay, and this is what you got, right? Ultimately, financial conditions ease, credit tightens, equities rip. So the good news is when you get up into this area, you're getting close to setting off alerts on their screens. Right? Like hypothetical. Let's say next week shit really starts to hit the fan in Iran or whatever. You get financial conditions break out, tighten even more. You get credit widening out even more. Something's going to have to be done. You know, something's going to have to be done. It puts everything on fast forward is kind of the easy way to say what I just explained. It puts everything on fast forward. You know, so that's the good news. And, you know, Sharpies may be sniffing that out already, guys. We refer to them as Sharpies for a reason. Okay. They're not like us. They don't poop their bloomers. They're okay with taking on some water when they put on risk. All right. They could be sniffing that out already. Okay, like look at Sharpies. Okay, we can't do with it. Like look what they did in 2022. Okay, they took off their hedges here. Okay, but then again, let's say right, they got to neutral, then put back some hedges on because this rally was insane. I don't know if you remember kind of the first bear market rally in 2022. Here's what it looked like. Let's just take a look at it for entertainment purposes. It was this here. Oh. It fooled me. I lost money on some calls. Here. Okay, so here was the first pullback in 2022 and straight line into an upside liner. And at that point, Sharpies added back a little bit, some of their hedges, right? Then the market rolled over, made new lows. Look how aggressive they got from that point into that summer bottom, which I tell you is, according to the signals that we follow, was the real bottom. That summer bottom, look at this. Whoop. Oh, what the hell did I do here? Oh, okay. Not a fear in the world. That's like having tomorrow's newspaper. That type of conviction. Okay. Then you had another huge squeeze in the market. Look like this. I think it's snowing out, by the way. I just looked out my window. I see snow. This is what the market looked like. This was the rally right here off that low. So even bigger than the other one. Niner overshot. Okay. At that point, they trim a little of their long exposure. Now they're aggressively net long. They take that down into the highs. Market comes down, make a new low, and bloop. This right here was the SIVB crisis. That was probably the best of the buy signals right there. As Twitter, I remember Twitter like it was yesterday. all the tweets on FinTwit. Oh my God, it's a bank run. I tried to take money out of my PayPal and they wouldn't let me. It was pandemonium out there. Okay. Sharpies, what'd they do? Yeah, okay. Bank run. Give me that. Whoop. To one of their largest, like you can understand, these are dealers, hedgers. Their job is to minimize risk by hedging. That's why they call her hedgers. Okay. When things get overdone, or for whatever reason, they think risk has already been fully priced in, they remove those hedges. Right? That's what this is. So at this point here, they were aggressively long of equity index futures. Probably the most risky time, what it felt like to us in the market. Banks are going under, SIVB went under, and Sharpies were as aggressively long risk as they can possibly be. Right? So that's why, like, we get, let's say shit again. It was a ramble from my earlier point. If shit hits the fan next week and you get this into that alongside puke signals all over the place, alongside credit and financial conditions setting off alarm bells, my friends, that's what we refer to in the biz as a sweet spot. OPEC next week too, yeah. Could get really messy. But again, this market's crazy. We honestly, I think we have as good as a shot to squeeze. I think we got a better shot. How about that? To squeeze than we do from getting that. Just prolonging our agony. But again, it tests your patience. You know what I mean? It tests your patience. You have longer term positions that you're holding, especially investments. Obviously, you don't want to fool around with that. Right? You got stuff longer term, you leave it alone. All right. You got some stuff that you're holding on through the prior rally that you're trying to hold on longer term. Right? You try to leave that alone. You feel a little uncomfortable, you put on some hedge, like we talked about. But the key is that finding the discipline and the patience to wait this out, right? Especially if you are fortunate enough to be in an elevated cash position, right? Because you paid attention to the risks that were out there. The trick, the name of the game here now is to be patient. Because the truth of the matter is, okay, the short squeezes, don't get me wrong. I feel the same way, especially like I haven't, like swing. You want to swing stuff, right? You want to make decent bets and give them time and try to make a decent amount of money. So you get antsy. But you want to take a step back and take a bigger picture view on things, right? You try to take advantage of the short-term squeezes. Okay, but ultimately they're just that, right? We want to see things start to light up green on the other side of that. And then that's where we can get a little more aggressive, right? That's where we want to get a little more aggressive. The short-term squeezes, some you hit better than others, some you time better than others. Right? Some you're a little earlier, some you're a little later. But for me, that's the name of the game, is to be patient through this process. Right? Play, like we said, you're gonna make some money, you're gonna lose some money, your hit ratio is gonna come down dramatically. We've been talking about that for like 2 months now. For 2 months now. But the main goal is to get to a point where the other side of that short squeeze has some upside capability. Yeah, it's just there. We've been through a period here where just from a risk reward perspective, it's not worth trying to cash that big ticket. There's nothing wrong with trying to swing for the fences, but you got to wait for your pitch. Not to get sound too corny here, but it's the truth. There's nothing wrong with trying to swing for the fences, but there are better times to try to do that. All right. We had a market here. God, guys. Look at this. Look at this. Right. And not only that, this rally had everything for everybody, no matter what type of player you were. You're a large cap player, you're a tech trader, you're a small micro cap player, you're a speculator, you're a gold player. Whatever concoction of a risk asset you can think of, you benefited from this rally. Okay, it's not going to last forever. And as you get longer in the tooth, even if the market doesn't come in, right? We talked about this. You get less and less opportunities to find places to put on new risk. This has to get digested and washed out. Right? Reels in a lot more new bulls. It reels in sloppy new bulls. In October here, which again, this without the cyclicals, this was kind of the glaring top, even though the markets went higher than that. You got to blow off top in so many different areas of the market on the speculative side. Literally blow off top. So this is just the process right now of digestion. Right? Sometimes you get sharper drawdown corrections. Sometimes you got to deal with it through time. But again, almost always there are a few exceptions. After it runs its course and shit lines up the way it lines up on the sentiment position side, you're left with everybody de-risked, from funds to systematic funds. CTA funds went from max long to short. Everybody de-risked. Nobody owns equities. Players are caught with their pants down, betting on more downside. And then things start to turn. And then ultimately, all that is the fire up the ass to get this. You just, again, like I said, you just got to let it play out. You got to let it play out. Whatever it is to get you through this process. We talk about that so many times on this webinar, in the STEAMROOM, on the webinars. That was, for me, that was like, again, for my style, that was the big hurdle I had to get over, is finding a way to get through this process without lighting all my money on fire. Right? All the money that was made here, holding on to the bulk of it through this process. Because when you have degenerate blood, like most of us do, it's not an easy feat. It's not an easy feat. But again, from where we were to where we are now, that process is underway here. How much is left? It depends on how this latter part shakes out, right? If we get an accelerant, we get something that cracks because of financial conditions and credit, likely is going to put things on fast forward, and we get through the process quicker. but these are that part is trying to predict macro and geopolitical shit. It's an impossible feat. Did it? Oh, yeah. That's another thing, right? I mean, which is not always correlated to equity. What do I do here? Not always correlated to equities, but what happened to my charts here? How do I? Oh, hold on. No. Wait a second. Oh, there we go. The move index, which is basically the VIX of the bond market. Like, look. Okay. Now, again, just to give you guys an example, for those in the steam room too, while you're here. Oh, where am I? Hold on. Okay. This is literally what? Late February? Okay. Rollover. This told you this was coming. Right? Move here was laying dead, doing nothing. Okay? This told you that was coming. Right? And that is going to weigh on equities. Though that's the beauty of those signals. That's the beauty of those signals. But we're not too far away. We're a lot closer, time-wise, than where we were. And it doesn't mean the news gets better. It probably gets spookier out there. I'm sure it will. But a lot of the stuff that needed to happen, it's already underway. It's been underway. But that's interesting on the move. I didn't even realize that today. Quite the pop. Yeah, they always do though. They listen when you got credit acting up, the financials are going to take the bulk of it. That's nothing new. That's nothing new, right? I mean, it's on their books. That's the risk. It's on their books. So they always do. They always do. I mean, listen, you had, again, if you remember in 2022 into 2023, you had some regional banks going under. But again, it's a common thing. Right? And it happens closer to the end than the beginning. Understand? The only time it really happened at the beginning was 2008. And they let Lehman fail. If they bailed out Lehman, probably singing a completely different tune. When they let Lehman fail, that's when all the sharks, the bears out there, started sniffing out, okay, who else has got this shit on their books? Oh, Merrill? Let's go sell some Merrill. Bear Stearns? Let's go sell some Bear Stearns. All right, because if they're going to let Lehman fail, what are they going to do? Are they going to bail out Merrill and Bear Stearns? That's not right. They did it anyway. They had to, but and ultimately they print as much as they got to print. They do enough QE, they do what they got to do until they stop the hemorrhaging. But the financials leading the downside is normal when credit's involved. You know, and I think what's happening now in credit, because financial conditions are tightening, right? Yields are going higher, financial conditions are tightening. This puts more pressure on the pockets of credit that are already having issues. You understand? What would be relief to the credit issues? Lower rates and the Fed taking some action, right? Right now, you got the opposite going on, the opposite effect. You got financial conditions tightening. So ultimately, something's going to have to be done to break that fever, as we said earlier. Yeah, again, listen, if we rewind to where we were going into earnings season a few weeks back, what is that, maybe 3 weeks ago now? Okay. If we were going to have a correction, there's nowhere to hide, guys. That's the thing. They smoke them out of these hideout areas. There's nowhere to hide. So what we've been seeing in early 2026, okay, there were places to hide. Early New Year, January 2026, buy the cyclicals. Stay away from tech. You could hide there. The cyclicals exploded. Okay, now you got some risk in the cyclicals, right? Where can we hide? The semis. Still growth, still some momentum there. Let's go hide there, right? You get rotation until they run out of places to hide. Now even gold, you're getting something. You can't even hide out in gold, right? This is normal stuff. Right now, the only places to hide are stuff that are benefiting off what's going on with the war, right? So crude and ag names and all this shit. That's what they're crowding into. Okay, what's the risk there? What happens if you get a resolution to the war and shit like that? What happens if you get a resolution to the issues we're dealing with right now? What do you think? The ag names go parabolic in that? They sell the ag names. It's just, again, normal RSP correcting off the highs after this type of rally like this is all part of the game. This is normal shit. It's supposed to happen. This is, for, again, the point I'm making here is this is not, for me, this is not a tell. The tell was a month ago. Now the shit is playing out. You understand? That's the point I'm trying to make. Now you got the stuff playing out. This is not an early tell on what's coming. All right. I mean, you look here, you guys, how quickly we forget. Here was going into 2025. It was even worse, in my opinion. Here's 2025, right? This was the only minor correction prior to that little bloop, bloop, bloop. Okay. But this was going into the year. Players piling in to literally everything off Trump taking the lead in the polls and getting elected. Okay. What would a correction, a legitimate correction, look like in a market that's rallying like this? Not going to look like this. Okay. This is what it looks like. Now, right here, okay, you'd be saying, oh my God, this SPY doesn't look good right now. There's got to be something going on. But it's already happened. It's already happening. It's never good. The corrections never look good. They break down. You break down uptrends. You break down anything bullish you can possibly imagine. That's what shakes out everybody. When you have bullish shit to hang your hat on, you don't correct. And then just when it looked its scariest, right? When everybody's puking, oh, this Trump is a nut job. He's slapping tariffs on everybody. He's going to take down the whole global economy. How quickly that changed. And then fast forward to where we are now, you got rumors of an Iran war just a few weeks ago, right? And nobody's worried about anything. Oh, yeah, no. Buy this name on the dip. Oh, no, we're going to hide out here. We're going to hide out there. We're going to hide out everywhere. But this is just normal market shit, you know, a little more aggressive because of the machines and the zero DTE and levered ETFs and all that jazz. Same cycles. Oh, I thought you were talking about RSP. My bad. PSP. My bad. Yes. This is the problem child. You're 100% right. This is the problem child right now. And again, they need this to break, right? Oop. This is what the fever that needs to be broken right here. This ultimately is going to put pressure on that. Right? You see how from time to time it goes away, you don't hear about it. Improvement, you think, blah, blah, blah. Still, as soon as financial conditions tighten, they smell blood. They smell blood. You know? And again, you know, when you usually we get here, you're gonna a lot of times you hear something go boom, you hear something crack. That would be totally normal, you know? Like we had owl already. Like this owl goes down every day. It's like every day it goes down. Look at this. You know? But again, you look at these charts, look. All right? Party doesn't last forever. You do that, the other side, it's not going to look good when it shows up. But, you know, they've taken out a lot. Have you seen these spec stocks of late? You know, there's no bid in these things. They've hammered these things. You know, every stock that these jabronis on X were pumping left and right, it was nauseating every day. I used to look at my X timeline. I don't even follow these characters. Pumping these stocks, all the same stocks, all the same theme, right? They've taken the air out of all these things. On a positioning, sentiment, speculative side of things, we are in much cleaner shape than where we were October, November. Much cleaner. So much cleaner. You know, we still might have some work to do, but honestly, guys, I don't think there's a lot of work to do. You know, putting a timetable on it is nearly impossible. You know, because it could happen quicker, right? You get news behind it, you put it on fast forward. but we're not all that far away. Like this is another one I like to look at. I think I showed you guys last week that we would like to see at the end of this. Oh, I showed it to you, right? The panic breath thing, sentiment cycle. Wait, did I? Hold on, I got an updated one. Let me show you that one. Hold on. Here it is. Oh no, I showed you guys panic breath, right? That's the one I showed you guys. Here's another cool one. But these things really start to boogie as you get closer. Let me see if I can take a normal screenshot here. There we go. Where am I going to put it? Can I put it in here? Oh, it doesn't let me post in there. Hold on. I don't have permission to post. I'll kill somebody. Hold on. We don't want to get too sidetracked from the noise. Listen, there's, as much as I say, there are going to be people who get sidetracked. They're going to get people pooping their bloomers when they shouldn't be pooping their bloomers. What are you going to do? Here it is. All right, like it looks like you still got a good amount of work to do, but this thing really starts to pick up quick once it gets moving. It goes in a straight line. All right. So here is the April low. Here is the November of 2023 low. I'll get back to 2022 in a second. Here is the COVID low. Here is the 2018 low. Okay. Now, COVID here, 2022 is the outlier. You had the first initial jump, right? It receded a little, and then the summer low, which again, to me, was the true low, right? We talked about. Okay. But why does this look different than the others? One reason. You had the Fed purposely rigging the game to the downside here, right? Because the Fed allowed inflation to get out of control, you had them purposely tightening financial conditions to battle inflation. So the market's always rigged to the upside. One of the few times, the only time I can remember in my career, it was rigged to the downside was 2022. It was literally rigged to the downside. Okay. The difference here and right now and all the others, you don't have the Fed purposely trying to blow things up. Now, if your rebuttal is hyperinflation and you think we enter a hyperinflationary state, then we got serious problems. But we got a lot bigger problems than the equity market on our hands. Usually these bull cycles, there's a common denominator in all of them when they come to an end. And it's the Fed purposely popping the bubble. You understand? They purposely attempt to slow down the overheating that's taking place. A lot of times they do it and it doesn't work and they have to do more because things continue to overheat like in 99, 2000. But eventually all that bubble popping they do eventually takes its toll. Right? We don't have that here. The Fed's not trying to pop any bubbles. And it's only a matter of time, whether it's Powell in the limited time he has left or whatever, or somebody else, before they have to take action if things get any uglier. Now, what we're seeing now is because the Iran war, you have crude oil, you got inflationary signs, right? But what usually happens is that the price, the inflation has an impact on economic growth. And that ends up slowing shit down. And then the Fed has to do something about it. Yeah, exactly. They probably not going to come out and say we're doing QE unless we get hit with another terror attack or something like that. They can probably get away with saying they're doing QE, but they'll probably just rename it something new. Twist, non-QE, QE, reverse repo mechanism. You know what I mean? They call it something else. But in simple English, it's rigging the game, which the truth of the matter, they have to do. You understand? Once you cross that line, that's what a lot of people were warning about in 2008, is that once you cross that line of the Fed put, it's impossible to get away from it. And then the more you do it, the more the market needs it, the economy needs it. You get to a point where you can't even, there's no economic growth, there's no excitement, there's no nothing unless there's stimulus involved. That's kind of what we're dealing with now. So that's kind of where we're at. And again, I think we're, at this point, I definitely feel comfortable saying we're closer to the end of this. There still could, like I said, there still could be some time. Something could put on fast forward for us. But you got to understand, there's so many balls in the air too. Which is probably a higher probability now. You get some sort of terrorist attack. Right? You got things that can materialize here. So that's what makes it dangerous to kind of get aggressive before any of these things are there. Right? We want to see this stuff there before no, the war, I don't know what's going on with the war. I'm talking about the end of this correction. The war, nothing ever ends. War, been at war with the Middle East since I'm in diapers. Never ends. But all this stuff having an impact on the equity market is kind of the apocalypse. The end is near. I see you. Yeah, it does. For one reason, it bothers me. Okay. And that's a great question. The one reason it bothers me is because all these mopes on CNBC and Bloomberg who have been burying people alive, telling them to chase names at blow-off tops, they hold on to the excuse that the equity markets are still resilient and they're still bullish. That's the biggest thing that bothers me. They don't talk about the names that they were recommending that have buried people alive. They talk about that they've been bullish on the equity markets and we're hardly off highs. But underneath the hood, you got carnage out there. Legit carnage. It kind of, again, nothing's ever the same, but in late 2018, you had something similar where they were the FANG. Before Mag 7, it was FANG that was holding up the markets back then. Okay? So the equity indexes here, the equity indexes, was it here or here? I think it was here. The equity indexes, were hanging in there net, right? Like they really didn't go anywhere. But underneath the hood, you had things in all-out, full-fledged bear market mode. At that time, it was a lot of the cyclical names and stuff like that. I think it was the trade war, if I'm not mistaken, was going on. But again, like, this is what happened here, right? Okay? Again, that looks really spooky, but that's 2 weeks of selling and over. And over. You know what I mean? So I think, to your point, okay, if you're saying if that's a risk, it certainly is. Okay, there's a risk that this could go like this, bloop, bloop. But at that point, it's probably over. That's what I mean by closer to the end. Does that make sense? Right? That's the risk now. Okay? The risk is you start to aggressively buy here, okay? And credit deteriorates, financial conditions continue to tighten, or there's some exogenous event, a terrorist attack, something that happens, right? Your risk is you buy here and you get caught in that. So that's why what we want to see is again, all these things we're looking at get to here, right? Because what that will tell us is that the majority of selling has already taken course, okay? Instead of it occurring in a 2-week free fall period, it occurred over a course of time here. So now you get a market sell off for a week and it's over with. But there's two-sided risk too to that, right? I mean, there's also a chance that if you're waiting for the markets to really fall apart here, you kind of hang in there, continue to hang in there, and then we correct it through time, right? Through this whole period, you had enough hedging and selling and all that to get a lot of these readings to where they needed to be. So yeah, there is that risk, right? That's exactly why we're not on here the last couple of weeks saying, "Oh, listen, we just got to buy," right? Like if you were here the April Liberation Day lows during that period, right? Again, none of us. I'm the first to admit I didn't think we were going to snap back this aggressively, right? If you guys remember how I was phrasing it, is that we'd probably linger here for a bit. But that would be a good thing because we would take advantage of that by buying stuff we want to own over a longer period of time. But then we had our buyer caps on, right? We had to do buying there. We had to do buying off this low because there was capitulation, right? All these things we're looking at were flashing bright green. So even if there was chop and weakness to linger, we want to take advantage of that by looking for stuff that we like on a longer term basis to buy. Start collecting shit. You know? So here, to your point, you really can't get aggressive to doing that yet, in my opinion. It's a little too early for that. It's a little too early for that. But at the same time, I don't think it's that far away, if that makes any sense. Yeah, we're taking hypotheticals. I don't know what the next week or two looks like. We got a down week, right? You got a week of selling. What do all these things we look at look like? You understand. Sometimes I can't find the words to make it sound like English, but you guys know what I'm talking about. That's why I like to show pictures. Yeah, I know. Again, that's what scared us here. Okay. Now that this has happened, like what are we off the highs now, percentage wise, roughly? What are we off the highs? Anybody got quick math? Again, it depends what index you're looking at too. But let's take the S&P 500. 5%. Okay. So, I mean, you know how quick we could shed off another 3 to 5% in this market? How quick that could happen with some sort of catalyst, legit catalyst, like something cracking in credit or geopolitically or something? Oh, thank you, T. I appreciate that. So, yeah, I agree with you. Not having a legit correction. We've been talking about it on this webinar for a while now, you know? You need it. The longer you go without it, the more concerned we get. But the point I'm trying to stress is whether the index has corrected 10% or not, this is a correction that we've been going through. Period. You can't say otherwise. I don't care what the index is percentage was or off the highs. You got carnage out there. You know, you got a lot of bloody stuff out there. So it's been a rotating correction. A little different look. It's been rotating from sector to sector, pocket to pocket. That's the type of correction we've been going through. And that, by the way, is the ultimate pain trade. Young bull, think about that. Everybody we know on the professional side, you know how they were positioned? Buy whatever they want to buy and hedge that with SPY puts and VIX calls. Okay? So you buy names and you hedge those names with SPY puts and VIX calls. And you know what the pain trade is? You destroy the names, and SPY and VIX really don't move enough to soften the blow. Hedge pain, yeah, right? That's what we've been seeing. I mean, you see this, right? This is not make believe. You see this vol panic chart I showed you guys. That's what this shows. The ultimate pain trade. So all these players were taking it. They were long Mag 7. Oh, great fundamentals, or long Nvidia, or long anything that they thought would make money if a market hung in there, and they were hedged with this, and they lost money all over the place. You know, so again, listen, I'm always, as many of you know, a glass half full guy. Right? I get thrown in the perma bull camp a lot. Um, it doesn't pay to be bearish in this market, but as many of you know, I get pretty cautious when things get out of control. Okay. I'm not as cautious as I was even just a month ago. You know, and again, cautious too, I use lightly because I think it ends up being an opportunity. That's the beauty of it. If we're patient enough, it ends up being an opportunity. Niner is a downside. Oh, by the way, you reminded me on that. Niner is a downside exhaustion, if I could speak English, signal. So it's Tom DeMark, and it's his indicator, just basically upside and downside exhaustion, where buyers and sellers should show signs of exhaustion. So you got a niner on most of the indexes here. You know, again, I'll leave it at this, and then I got to run. But for those and Steam Room members will know exactly what I mean. But for those who like to place bets for snapback sentiment squeezes, I think you got to start looking here. Even with all the stuff I said, you have to start looking here. Now, again, this may be the one that cost you money, right? It's always one that cost you money at the end. But as far as the indicators are concerned, you're looking for snapback sentiment squeeze here, right? And what I mean by snapback sentiment is kind of what we've been dealing with. It's not an end to a correction, but you get a worthwhile squeeze to sell into. Again, on a short-term time frame. All right. So, like for example, the way I'm going to play, if you're wondering, but I played a lot more conservative than people in the Steam. Like people in the Steam room will buy some SPY calls or Q calls. Right. Tomorrow the market opens up down or weak. So you don't go crazy. You buy some SPY QQQ calls looking for the squeeze. What I like to do when some of the bigger picture signals are still signaling caution, but short-term signals are signaling squeeze, I like to try to catch it intraday. So what I look for is when, like tomorrow we come in, and for those in the Steam room, most of you know what I'm talking about, but if you're new, if we see some constructive signs from credit, right, or vol or flow, I like to buy TNA or TQQQ, or maybe they are aggressively sweeping a name. I'll play that name. So like tomorrow, I'm going to look to try to catch a squeeze. Any constructive signs out of this? Like for example, this credit indicator, for those of you who have been around the last couple of days in the Steam room, really hasn't given us a window of opportunity over the past 2 days. It's been straight melt. Straight melt. So tomorrow, again, on an intraday basis, even if there's a little bullish divergence, I'll try to get my hands on something with a stop and try to catch it that way. I'm not going to get rich. I'm not going to, I'm not even going to make a big hit. You need to usually hold overnight. And, well, again, it depends how aggressive you get. But I'm just looking to catch a squeeze. I'm just looking to catch a squeeze. I don't always catch them nice. A lot of times, because I'm trying to catch it intraday, I just can't time it as well as I like to. But last week, there was one that a lot of us timed nicely, where we had some bullish vol and credit divergence intraday off squeeze signals, and it was a nice squeeze that day, if you guys remember. So it's a more conservative way to try to make some money on the long side while we're waiting to get through this. All right? The goal is to pick up the money during this period on the long side. All right? Here's where we want to pick up the money. In this. And then during this, and wow, it's snowing out there. At this and this, we want to protect our money, right? We want to feed the degenerate temptations we got, but we got to participate. We can't sit on our hands and do nothing. We're not wired that way. But we're gearing ourselves up for a risk-on move whenever it does show. You're from 99, you started playing? Wow, so there, I got somebody I can relate to. Yeah, I started playing, well, I got Series 7 licensed in, 98. I started following the market in 97. I became a broker in 98. Wow, you were born in 99. Wait, you were born in 99? Oh, God. Leave me alone. Why does you youngins like to make me feel like shit at the end of every single webinar? Why? Unbelievable. Born in 99. The hell out of here. I wish. So what are you, 20? What year are we in? this is 2026 we're in. Holy shit. I mean, Jesus Christ, you're in your prime. I was taking over the world at that age. I didn't have a worry in the world. 26. Oh my God. You know what 26 is? Oh, you're still wet. You're still wet behind the ears. 26. Like once you get into your 30s, you mature a little bit. You're still a cowboy at 26. I can't talk to you anymore. What the hell are you worrying about? I don't want to hear any concerns out of your mouth at 26. Oh, man. So sad, Madden. So sad. Stop. Alicari's right. I can't take it. You youngins. All right, everybody. Stay safe out there. We're in a crazy world. But for the market, again, I don't have a crystal ball, but I think we're closer to the end of this thing. But we still got to be patient. That's all. We still got to be patient. And we'll know when things start to change anyhow. We'll know. The signs will be there. All right, Steam Room members, I'll see you bright and early mañana. The rest of you, good luck, good luck tomorrow. We got OPEX next week, and I'll see you guys next Thursday. Later, everybody.